In this episode, you're going to get epiphanies and insights into how you can use an IUL laser fund as your foundational asset, where your money's liquid, safe, earning a rate of return until you need to use some of that money to seize other investment opportunities and keep earning money while you're doing that. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. And one of the concepts that I love to teach people is how to become their own banker. And so we do this by using a laser bank. Now, LASER is an acronym that I've used for years that stands for Liquid Assets, Safely Earning Returns. And so on my most recent best-selling book that I would love to gift you a free copy of at the end of this episode, but it's called the Laser Fund. And so you see 4 pillars on here that represent liquidity, safety, rate of return, and tax advantages. Those are the key elements of a prudent investment. So let me understand this really clear before I go into how you can use it to seize opportunities on other investments, but it is your foundational asset. Now, in a lot of the books that I've authored throughout my career, I have this risk-return paradigm in the books, and it lists 16 general categories of investments from highest risk to lowest risk. And so most people are familiar with these types of investments where you can have money. When we apply the liquidity test, liquidity is the ability to access your money when you need it, maybe even with an electronic funds transfer or a phone call. This many fail the liquidity test. You can't access your money either quick enough without waiting to sell the piece of real estate, for example, or maybe if you access money, it's going to trigger a 10% penalty by the IRS plus trigger tax. So you pull out, $100, you're only netting $60 after penalties and tax. That does not pass liquidity as far as a prudent investment very well. And so that's liquidity. Now, the second is safety. This many more fail the safety test. Now, not only safety of the institution where your money is parked, but safety of your principal. Now, if I set aside serious cash for a long-term goal, such as retirement or college funding for my kids and grandkids or what have you, I don't want to jeopardize that. That's serious money. So very few investments give you safety of principal because if you have your money in the market, it's subject to market volatility and you can lose your principal. You can even lose your principal in a certificate of deposit at a bank. If you redeem it early, you may not even get back what you put in there, okay? So this many do not pass the safety test and liquidity test. When we apply the third test, rate of return, this many more fail. Rate of return, you have to have a rate of return greater than the inflation rate, for example. You can't be rowing upstream, so to speak, at 3 miles an hour. 3% interest is what I'm talking about in a bank or credit union when the current of inflation is coming down at 8 or 9. You're going backwards, right? When we're talking about this banking concept, you have to have a rate of return greater than the cost of the funds, or it doesn't behoove you to do that. Now, keep that in mind. If you don't know what I'm talking about, I'll explain it here in just a moment. We have 3 final possibilities, maybe a very small handful of mutual funds here, number 10, maybe a very small handful of annuities, but number 12 is my favorite, and it's actually the least understood in America. I want you to understand this because you're missing out until you do. Now, what is that? It's number 12 is max funded insurance. It's my favorite because it's the only vehicle out of all 16 that gives you a tax-favored harvest. So what do I mean by that? Let's say you were a farmer and you have the choice of buying your seed in the springtime and you buy it and you don't have to pay tax on what you pay for the seed that you're going to plant. You plant it, you irrigate, you cultivate, you work hard, and then in the fall, you harvest your crops and then you agree to pay tax on what you're going to sell your harvest for. See, that's like a traditional IRA or 401k. You get a tax break on the seed money, but you pay tax when you go to retire and use the money and harvest your money, okay? Frankly, I'd rather pay tax on the seed and enjoy the harvest without tax. And that's what you have with max-funded tax advantage insurance contracts. Roths do that too, but I've never owned a Roth and never will, because Roths only have two advantages. That max-funded insurance has had those two advantages for over a century, plus four additional advantages Roths will never have. So why mess around with a Roth when you can have the two advantages of a Roth and four additional advantages, okay? And you can watch other episodes to understand what those are. So let's look at this. On the front of my book, you'll see these four pillars that represent liquidity, safety, rate of return, and tax benefits. And so when we look at a properly structured max-funded IUL, Indexed Universal Life, the liquidity test, it scores on a scale of 1 to 10 at least an 8, okay? Because you can access money when you need to, even maybe with an electronic funds transfer or a phone call. As far as safety, it ranks 9 out of 10. Very few places are as safe as legal reserve insurance companies, which are the backbone of America and the backbone of the world. When we talk about rate of return, it usually scores at least 8 out of 10, because the rate of return that I've always earned has outpaced inflation, and the rate of return is quite easily greater than the net cost of the funds when I am my own banker, as I'm going to show you here in just a second. So when we talk about tax advantages, nothing else in the Internal Revenue Code allows you to accumulate your money totally tax-free and then access that money anytime, even before age 59 and a half, without a 10% penalty, tax-free. And at the end of the day, when you die, whatever you leave behind increases or blossoms in value and transfers income tax-free. I've taught advanced continuing education to CPAs and tax attorneys for years, and I've always asked them to show me any other investment in America that does that, and they've yet to show me that. So it scores a perfect 10 out of 10. You add up those four numbers, and you end up with 35 out of a possible 40 points. Nothing else comes close to that. IRAs, 401ks, mutual funds, annuities, they score between 19 to 22 or 23 out of 40. So a max-funded L.A.S.E.R fund, IUL L.A.S.E.R fund, isn't a little bit better. It's a whole lot better. That's where I keep my foundational money. And then I can fund other investments using it as my own banker. So with that foundation, let me show you what a L.A.S.E.R bank does. If I have, let's say, $1 million of cash accumulated in my IUL policy, and now I'm going to keep it simple here, but you could have 10 million. We have clients with that much, or 100,000 or 10,000. It doesn't matter. But if I have $1 million of cash value in that, and I want to use that million for another investment or opportunity, or to build a piece of real estate, or even mess around with cryptocurrency, I don't care what it is, I can go to the insurance company and I can withdraw my million, but that's not the smart way, because now it's no longer in there earning interest. And I average, 7, 8, 9, 10, 11, 12. I've actually, because of rebalancing and diversification, I've averaged 9 or 10%. So let's say it's earning 10%. If you withdraw your money, you're no longer earning 10%. So the smart way is to leave the million in your policy, and the insurance company will loan you $1 million. You don't have to fill out a loan application. Yeah, it's your money, but they're using it as collateral, okay? And so if you had $1 million in the bank could probably loan you $1 million if you just left $1 million in a savings account, but the bank will probably charge you higher interest than they're crediting you. With an insurance contract, it's the opposite. See, the insurance company will loan me $1 million, and so my $1 million stays there earning interest. It's going to, let's say it earns 10%. Now, some years you might not earn anything. Other years you might be credited 25% or more. But on the average, it's been around 10%. So if I go to access the money, I can borrow from the insurance company at a zero-cost loan, and they might charge 2% because, see, loan proceeds are tax-free. If it's not deemed a true loan, then when you get money out of here, it's not tax-free. And so they might charge you 2%. Okay, that would be $20,000 on $1 million loan for an entire year. But they'll credit you the same 2% on the $1 million that you left there as collateral. They charge you 2%. They credit you 2%. That's called a zero-wash loan. It doesn't cost you anything. but now it complies with the IRS rules to be tax-free, okay? But you can use an index or alternate loan, which is what most savvy people do, and so they might charge you 4 or 5%. Oh, why would you be willing to have them charge you 5%? Because now they're going to credit you, not the same 5, they're going to credit you whatever the index rate is. Sometimes 10, 15, 20, 25. So if you get credited 10, they charge you 5. You don't have to write out a check for the interest. Yeah, I mean, you can if you want, but they subtract that. You're netting, okay? You're still netting 5% tax-free on your money while you're using it, so to speak. And that's 100% more. How much more is 10 than 5? It's double. It's 100% more. So far, so good. Let me show you how this works. I have an individual, he likes to invest in real estate, but he keeps his serious cash in IUL. The IUL is the working capital account for business. And whether it's for inventory or real estate or whatever. So in 2017, he needed $1 million to tie up for a strip mall that he wanted to buy, fix up, and flip. He doesn't like to keep them. He has a pool of clients that they want out of their apartment complexes or their strip malls, and then he buys them to make it a win-win, and then he fixes them up, and then he has a pool of investors who want to buy fixed up, upgraded properties, okay? So he needed $1 million to tie up a property with an earnest money. So he simply called and said, Doug, send me that form. Well, he's talking about a one-page form where he puts his name and his policy number, like an account number, on his IUL with the insurance company. And that form just says, do you want to withdraw $1 million? He doesn't check that box. Do you want to borrow $1 million from us using that as collateral? Yes, I want to borrow. Do you want to borrow at a zero cost loan, or do you want to borrow at an indexed loan? He checks that one. So in 2017, he borrowed $1 million from the insurance company. They charged him $5. That's $50,000. And that year he capped out at 25%. So he got credited $250,000 on his $1 million that he left there as collateral. Hello? So he got credited $250,000. They charged him $50,000. He netted $200,000 or 20% tax-free on his $1 million while he was using it to buy, fix up, and flip a piece of real estate. Probably made $2 or $3 million on that. Are you getting it? He used the IUL as a working capital account. That's his foundational end asset in order to invest in real estate, or I don't care if you use it to invest in crypto or whatever. This is the foundational asset when you understand how money works. So if you've gained some insights into the power behind liquidity, safety, and rate of return and the tax advantages of an IUL laser fund, or you want to learn more, I would implore you to claim a copy of our book, The Laser Fund, and meet with an IUL specialist so that they can show you how a properly structured max funded IUL can work in your particular set of circumstances. And so, this book is actually 2 books in one. This side is 14 chapters, about 200 pages, with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner and you learn more by stories and examples, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. Okay. If you want to use your whole brain, your left brain and your right brain, you can read both books. Now, this retails on Amazon for between $20 up to $60. And if you buy it on Amazon, I want to thank you. But I'll give you a copy for free. You simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, okay? But I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's those formats available for your investment. But you can even schedule to attend a free educational webinar that we teach every week. No cost, no obligation. But you can even schedule an appointment when you're claiming your copy to talk to an IUL specialist that will show you with no cost, no obligation, how a property structured max funded IUL may work in your particular set of circumstances. And you'll be on your way to understanding how to become your own banker.